Welcome to first part of this series where we are trying to evaluate what is the intrinsic value of Microsoft stock using the discounted cash flow analysis. Even before getting into the numbers, let's try to understand what are all the different steps involved in doing a DCF or discounted cash flow analysis, because this is a widely used method with most of the analysts or investors to evaluate what is an intrinsic value. And even before we start, a quick disclaimer: I'm not a financial advisor, and this is not a financial advice. Neither I'm not qualified to do so. This is just for an educational purpose only. So with that, let's get started. In my opinion, whenever we do a discounted cash flow analysis, it is only categorized as 9 major steps. So let's understand, or let's get on same page. What are all those 9 steps? The first one is calculating or projecting what is the unlevered free cash flow for the specific period. Here I have mentioned specific period because whenever we do a discounted cash flow analysis, we will project what will be the free cash flow for the next 5 years, because projecting for the 10 years might not be 10 years or even beyond it. It might not be very feasible because the business model might change. So pretty much as a standard, we will project it for 5 years. And here I have specifically mentioned as unlevered free cash flow. So first, let's understand what is the difference between the levered cash flow and unlevered free cash flow. Might be our textbook definition of cash flow is nothing but, let's go to the cash flow statement, figure out what is the cash flow from the operation, and net it out with the capital expenditure. We will get the free cash flow. Indeed, that is right, and that is the levered cash flow. But what unlevered free cash flow means is, take out the leverage. Leverage, in other words, is nothing but what is the interest payments which the business need to pay to the debt issuers like the banks or any other agency who have issued debt. So here, nothing in the unlevered free cash flow, we are interested to know what is a free cash flow which belongs to both the equity holders as well as the debt issuers. So that is why we wanted to be very specific to calculate what is the unlevered free cash flow. Might be in the next part, we will go through in detail how to get the unlevered free cash flow. Once it is done, the second part is determining the discount rate or WACC, or in full form it's called as weighted average cost of capital. So the reason why we need is, say as in the first step, we could have calculated the free cash flow for 5 years. Say in the first year, you could have calculated the free cash flow is $100, and by the fifth year, assume that the free cash flow is say $150. But the $150 which is going to be generated 5 years down the lane might not hold the same value of $150 as of today. So the simple example is, say if someone asks you, do you want $100 today, or do you want $100 5 years later? The simple answer we would do is, I want the $100 today, because $100 today is worth more than the $100 5 years down the lane. So that's the simple concept, and why the difference, or why the $100 today is worth more, is nothing but due to the inflation. And the similar concept we can apply here. So the business which is going to generate $150 down the lane 5 years, that $150 might not be the same $150 as of today. So we have this discounted rate which understands in what area the business is performing, how much debt the company have, how much equity the company have, and accordingly we will derive the WACC, or weighted average cost of capital. We will use this value, that is the WACC value, to discount all the unlevered free cash flow we forecasted for the 5 years to get into the current value. That is the step number 2 is nothing but calculate what is the discount rate we need to use. Then the third step is calculating the present value of projected free cash flow, which is nothing but, in the first step we got for 5 years each and every year what is the free cash flow. Second step, we got the discount rate. So use the discount rate and evaluate what is the as of today's, or as of the present values free cash flow. That is a step number 3. Then the fourth step will calculate the terminal value. So in the first step, we have calculated the free cash flow or projected the free cash flow only for 5 years. But the simple assumption is the business is not going out of business or anywhere after the 5 years. The business is going to grow even beyond the 5 years period which we forecasted the free cash flow for. So we need to assume at what rate the company will grow beyond the 5 years and evaluate how much cash flow the company can generate till its entirety. So pretty much whenever we do this terminal value calculation, we will take what is the country's GDP and project it to that rate. That's how we will get the terminal value. And the next one is calculating the total enterprise value. This is nothing but summation of the step number 4, which is where we got the terminal value, plus the present value of projected free cash flow, which is the step number 3. So step number 5 is pretty simple and straightforward. And the next one is calculating a net debt. So as of now, we calculated what is an enterprise value, but by end of the day, as any business, they take a net debt. Again, I use the word specifically called net debt. The reason is simple. Say if you go to any business, 10K or 10K report, and go to their balance sheet, specifically in the liability section, say assume they have mentioned as the long term debt as $5 billion and short term debt as $1 billion. So here the total debt is $6 billion. But if you could go back to the same balance sheet asset section, they might have one line item as cash and cash equivalents. There they could have mentioned cash and cash equivalents they hold is $1 billion. So in this case, the net debt again here is not $6 billion, which is nothing but the total debt. Net debt is the difference between what is the total debt they have versus the cash and cash equivalents. In this case, it's only going to be $5 billion. So we need to evaluate what is the net debt of the business. Then in the next step, we'll get the equity value. Equity value again is nothing but the difference between what is the total enterprise value, that is the step number 5, and step number 6, which is the calculating net debt which we calculated. By this, we will get the equity value. If you are doing valuation for any private limited company or non-listed company, your DCF value, your DCF method stops here. But pretty much most of the time, I presume, or at least I do, is only for the publicly listed company. So we need to do 2 more steps. The next one we will evaluate is what is the total outstanding shares. In simple words, we can get what is the outstanding shares from the most recent 10K or 10Q. Here, I specifically mention outstanding shares, or in very simple words, it's diluted share. You can get what is the basic share of a company by just visiting the cover page of most recent 10K or 10Q. But to get the total outstanding share, you need to evaluate if the company has any restricted stock units which can be vested out in certain period, or is there any option grant, or is there any convertible debt. So we need to evaluate, or so we need to read through the company's financial statement to understand is there any other additional share which can be diluted in a short term period of time. So that is why we need to be very clear to evaluate what is the total outstanding share rather than just the basic outstanding shares. Then the final step is very simple and straightforward, getting the equity value per share, because that is the final intent why we did the discounted cash flow. Calculating equity value is simple. We already calculated what is the total equity value of the business. Divided with the total outstanding share, we will get the equity value. So these, in simple words, these are the 9 steps which you are going to follow in the next 3 parts of the video to evaluate what is Microsoft intrinsic value. So in this video, we will just focus on the first step, which is how to get the unlevered free cash flow. Throughout this video, I will be referring to the integrated 3-statement financial model which I developed for Microsoft. Might be this is an more rigorous effort which we did, and I will provide the series of that playlist as well in the description section. If you get a chance, please feel free to feel free to watch it through. I know it will be like 2.5 hours of video, but most of the inputs which I need to get the levered cash flow, like operating income and some line items from the cash flow statement, I will get it from here rather than taking a random assumption. So in this financial statement model, what I have done is forecasted the entire income statement for next 5 years, forecasted the balance sheet for next 5 years, forecasted how the cash flow statement will look for next 5 years. On top of it, whenever needed, I developed a depreciation and amortization schedule, property, plant, equipment schedule, asset schedule, and long-term debt. Along with that, I have also developed how the street case will look like, how the best case will look like, how the weak case will look like. So everything is integrated. If I do one change in any way, the entire model will get updated accordingly. So this is what I did, and this will be the input for whatever I'm going to do now. So with this, without talking much, let's get back to the business and start evaluating what is the unlevered free cash flow. So I'll open up a new tab. So here the first step is unlevered free cash flow. Again, we have talked about what this unlevered free cash flow is in the previous part of video. But to reiterate, this is the unlevered free cash flow is getting the cash flow before any leverage is considered. Leverage is nothing but the debt payments or interest payments which the company need to payback to the debt issuers. So in that case, what we are going to do is take operating income as our baseline and evaluate what is the tax which the company need to pay to get what is the NOPAT or net operating profit after taxes. Then we'll add back the non-cash items from the cash flow statement to get what is the unlevered free cash flow. So if we'll get started, so what I will do is I will put 6/30/2025 because I think that's the recent year's last month, and then from here I will focus for the next phase. So I'll put this in short date. We'll just do a different color coding. Perfect. So first let's get what is the operating income, then what is the tax rate which we already got there, and then NOPAT, which is net operating profit after taxes. We'll evaluate what is this number. Operating income is here. We'll do this. Then the tax rate we already calculated, which will be like 18.28% for the next 5 years. Now NOPAT is just evaluate how much tax will the company pay. 1 minus this number. Okay, so this is the first input which we need. Then the second one is we need what is the change in working capital assets. So we will do that. Well, rather than doing that, we'll evaluate working capital asset, working capital liability, and then change in working capital. Okay, so here if you have watched the previous entire series, I have calculated two line item here, which is change in working capital asset and change in working capital liability. This is the two input which I do need here now. So what I can do is I will just link this. If it is asset, this is the number, and if it is liability, this is the number. So the total, no, it's not changed. So total change in, no, this is not even changed. Total working capital, which is equal to nothing but summation of these two guys. But what I need is just change in working capital, because by end of the day, if you remember, in the cash flow statement, cash flow from operation, we'll only have what is the change rather than what is the entire value of the cash flow. So we will just evaluate this differences. So here the working capital is increased, so we need to include a negative sign here. So just to be very clear, why I have included a negative sign before is we just needed to calculate the difference between the previous year and the current year. And or in very simple words, if you see in the previous year or 2025, the change in working capital is 9500 or 9.5 billion, and in the next year it is projected to be 113 billion, which is the number has increased by approximately 300 billion, which means the cash went out of the company. So that's why we need to be very clear about how we use the operational sign, I mean cash inflow versus outflow sign here. So we got this input as well. Now the next two items we need is D&A and capital expenditure, which is very straightforward. We don't need to do anything, just link it from our cash flow statements here. So depreciation amortization is this number, then capital expenditure is this number. So by doing a summation of this, we will get unlevered free cash flow, which is nothing but summation of this NOPAT plus this number plus this number plus this number. So we will get the total unlevered free cash flow which you are forecasting for the next 5 years. And one beautiful part here is, say, you could see for the 2026 we are calculating or we are evaluating the free cash flow as close to $76 billion. And as I mentioned in the previous beginning of this video, this model has three different cases: best case, street case, and B case. If I change any number here, you could see the numbers also changing there, because I'm just going to link from this financial statement model to the DCF. Say from street case, I'm changing to best case. Then you could see the number shot up from $79 billion to $85 billion. If I switch from best case to weak case, you could see the number change from $85 billion to $61 billion. So in this way, I can just switch or just do the toggle to evaluate in best case how the number will look like, in the weak case how the number will look like. So that's why I feel doing that integrated modeling or using the number from that is in two-way beneficial. By doing the switch, we can figure out what is the best case, weak case, intrinsic value. Second thing is, we know or we know what are the assumptions we took to derive all the numbers, and we should be confident about what inputs we give depending upon what we understood from the business, rather than taking randomly from any data source. In the next part of video, we will come back and evaluate what is the discount rate or weighted average cost of capital. Hi, welcome to third part of the series where we are trying to evaluate the intrinsic value of Microsoft stock using the discounted cash flow analysis. Then in this video, we will evaluate what is the weighted average cost of capital or discount rate or even WACC for Microsoft stock is. So with this, let's get started. So to calculate the WACC, there is this huge formula. It might look complicated. It says E by V rate of equity into, plus D by V into rate of debt into 1 minus T. Again, we have one complicated thing, says rate of equity equal to risk-free rate plus beta into market risk premium. Then I have provided a definition of it. Might be at a first look, it might look a bit complicated, but in the next 15-20 minutes, what we will do is, let's take each and every component from here and break it down and understand what it is, and from where to get input for all this information. With this, let's go back to our workbook where we are doing it, and I will rather use the same page and calculate the WACC. No, I would rather do it in a different workbook altogether because it will need a lot of time. So WACC, I will put WACC calculation. So first what I'll do is I'll just copy paste this formula from here into the Excel workbook, because this is what we will refer pretty much most of the time. So first I'll just input what are all the informations we need. So the first one, we will put rate of equity. Even for calculating rate of equity, we need three information: risk-free rate, beta, market risk premium. I'll put this risk-free rate, beta, market risk premium. So I will indent these three guys. Then next one, we need rate of debt, tax rate, which is T. And this one I don't need it indented. I will just put it back. So I calculated this, and then now I need E, which is nothing but market cap. I would put as E. Then I don't know why I used to get this way. This E. Then I need debt, which is E. Sorry, debt is D. Then I have V, which is nothing but E plus D. So what I did as of now is nothing but just provided the input of what are the numbers we need to finally calculate the WACC. We'll just do this in a different color, and finally we will calculate the WACC. Or even before that, we might need one more thing. I will just do this way. So first is E by V and then E by V. Then I'll put this. Well, we'll start with this four or five components because I feel this is the most simple thing to get it. Market cap, either you can just Google it and get what is the market cap as of the day you are doing the valuation. But what I would do is more simple way. I will just use the Excel function to help me with the market cap as of today. Select this, and then go here, put in, then come and type in market cap. But quick reminder or a gentle note, if you remember, whatever numbers we have used in the free cash flow, which is in turn linked from the financial statement model, all dollars are in millions. Maybe I'll just put this note here as well. But the number which you are seeing, it's a huge number. It says 3.619 trillion. It's not in millions. So we need to divide this by 10 to the power of 6 so that we'll get what is the market cap in millions. I'll just put, even here, all the numbers we are going to use will be in millions unless until it's a percentage. Then debt. For this, what I'll do is I will go to Microsoft's most recent quarterly filings, or if the most recent is annual findings, you can get that. 10Q is published on 10/29. I will figure out what is the total debt the company have. No. So here what they have mentioned is long-term debt, they have approximately $35 billion. Current portion of long-term debt, they have $7 billion. So this is the two guys we need. I'll just put in there. So 78, 32 plus 35, 376. So this is the two number we need. But again, even though they have mentioned they have $7 billion and $35 billion in debt, they also mentioned they have $28 billion in cash. So we need to net it out, the total debt which they have with the cash, then only we'll get the net debt. So what I'm going to do is I'm going to net out this $28 billion. 28, 849. So with this, I got what is the debt they have. So now we will get what is E plus D, which is this number plus this number. We'll got this one. And then E by V, which is nothing but this number by this number. And then D by V is this number by this number. I think I did something wrong. 21. Here it is. Okay. I think I want this in percentage. Put it in percentage. Okay, this feels much better. Okay. So what we are saying is, even though the company has around $14 billion in net debt, they have approximately 3.6 trillion dollar in market cap. So this debt is literally a negligible one. So now we got these two components, E by V and D by V. Now we are waiting for rate of equity, rate of debt. So for this, what we would do is first we will complete the debt part, then go back to equity. So to calculate the rate of debt, the most elegant way and the most accurate way to do is go to any data provider like Bloomberg or Seeking Alpha and calculate what is the debt which the company has to pay. That's the most accurate way. But the challenging part is It is a paid subscription and it's a hefty premium. I don't have it, and I couldn't, so that's why I'm not able to use it. The simple way to use it is go back to the most recent 10K report and figure out what is the rate which they are paying the interest for the debt. That we can use it as a proxy, even though it might not be the accurate one. I think it will be more or less equivalent. And even if it is not accurate, I feel, at least specifically while doing for Microsoft, it is not going to matter much, because we are going to multiply this rate of debt with the debt they have. Here, if you see, the debt is just like 0.39%, just literally a negligible one. But still, I feel it is a good proxy to use it. So what I'll do is, I'll again come back to this 10Q report, go back and figure out what is the interest payment they have made. Other expense slash net. I think I need to go here and figure out this footnote. No, not this one. I will go to annual filings. From here, pick it up. 10K. So total. No, I'll put net income. I mean, I'm just using a keyword to figure out the income statement. That's it, nothing else. So here, if might be if you could have read through this annual report, Microsoft in their last annual filing, they have provided other net income expenses one line item, and they have provided detailed footnotes what it consists of. In the other income or expense footnotes, they have clearly mentioned the interest expenses one line item. This is the one which I needed. But if I look at the most recent 10Q report, which was published as of the most recent quarter, that is of date, where is the date? I think it should be on okay, so this is the most first quarter of it. By end of September, they have published it. So I don't see the clear interest expense which the company have paid in this quarter. So I'm going to use the most recent annual report as a proxy. Here the interest expense is $2.385 billion. So what I will do is I will add few more lines here. Interest expense is 2385. Then I will go and figure out what is the total debt they have. So debt they have is, long term debt is 40152, total debt 40152. Then in short term they have 2.999 plus 2999 will just equal. So if I just calculate what is, if I need to just calculate what is the rate of debt, I'll just divide these two numbers. That will give me what is the rate at which they are paying the interest. So this one divided by this one, and this should be in a percentage. Say 6%. Even though it says 5.53, but I feel if you go and look at any accurate data provider, the number will be lesser, say around 4 or 4.5. But still, since I don't have that information, I'm just using this as a proxy. Now the next one is tax rate. We can go and figure out what is the tax rate which the company has paid in the most recent 10Q form. Okay. Our effective tax rate was 19% for both the 3 months ended on September 30, 2025 and 2024. This is from the most recent 10Q report, and figure out if they have provided any information on the annual report as well. Okay. Our effective tax rate for the fiscal year ended on 2025 and 2024 is 18%. I would use this one rather than 3 months because I feel somewhat confident about the annual tax rate rather than the 3 months tax rate. So I'll assume this is going to take this as 18%. So now what we have done is we got rate of debt and T, we got tax rate. So this part entirely is available. We just need rate of equity. For rate of equity, we need these three information. First one is risk-free rate. Let's first understand what does the risk-free rate means. As of today, say you have some cash which you want to invest in. That's why we are doing this exercise for Microsoft to further evaluate Microsoft is a good buy at this point or not. But consider, rather than putting in Microsoft, in turn any equity is a risk. The risk-free rate or the risk-free return or risk-free investment in the US is considered as what is a 10-year treasury yield bond rate. So we'll go back and evaluate what is a 10-year treasury yield bond, that is the risk-free investment. For this, what I'll do is I'll go to the CNBC. I think this one pretty much everyone can access. This is an open website. And here, I think I will just open this one, US markets. Here the first one we will get, this is US 10-year. If you just open, you could see US 10-year treasury. It says 4.167%, which means if you have some cash, you go and put it in US treasury for 10-year, you will get 4.16% as an interest per annum. So this is the risk-free rate which I'm going to use here. So 4.167%. Next one is beta. So what most of people do is evaluate what is the beta for Microsoft. So what I can do is I'll just come here and go and figure out what is the beta. Here it says beta is 1.07, which is done. But in turn, I have some issue with it. I'll come back later. The next one is market risk premium. This is how much more return as an investor expecting by rather not investing in a risk-free investment like bond. Say in a bond you are going to invest and you are getting say 4.17%. On top of it, how much you are expecting. Say it can be like 4%, 5% or whatnot. Say I'm just going to, for simple assumption, I'm just going to take it as 5%. With this, now I will calculate what is the rate of equity, which is the risk-free rate, that is this guy, plus this one into this one. Now we got what is the rate of equity. With this, now we got all the information, we can calculate the WACC. The WACC formula is E by V, that is this guy, into rate of equity, which is this guy, plus D by V, this number, into rate of debt, which is this number, into 1 minus tax rate, which is this number. So with this, we got the WACC as 9.509%. And if you have this number, let's wrap up this video and go to the next third step of it, where we will discount the projected cash flow for the 5 years to the current value. But as I mentioned, I have concern in two places here. The first place is how we got the beta and how we got the market risk premium. Technically, the beta what we got is just for the Microsoft stock, or even to a matter of fact, whatever company you're doing, the value how we got is the beta for that stock. But what if the company had got a significant high returns in the last 1 or 2 years, or other way around, the company had got significant downturn trend going for the last 2-3 years? So this number will be skewed, and we don't think, and at least I personally don't think, it's not safe to consider just one company and take the business, because by end of the day there will be some business which will be operating in the same landscape as the company you're trying to invest in my opinion. I feel more better or more comfortable to consider what is a beta, or what is a beta value for across all the company which the company which you're trying to target is operating in. For that, what I would do is, I will take help from, I think if you are in this investment world or trying to invest, you could have definitely known Professor Ashwat Damodaran. So he provides the clear data of what is the unlevered beta. Yeah, and also one more thing I forgot to mention, the beta which here we get, or if we got, is just levered beta. We want unlevered beta as well. So for this, I will go to, I already downloaded Professor Ashwat's data. I will just open it quickly. Okay. So here is Professor Ashwat's data. So here what Professor did is provided for each and every industry segment what is the unlevered beta. And Professor also mentioned how many firms he have accounted for this exercise. I think this is a well enriched data from which we can pick it up the information we need. And here, if you could scroll down, there will be some segment which says software, internet, software system and application. By end of the day, yes, we know Microsoft is going to be operating in a software business. We can just use this 1.22 or either 1.60. But how will we do is where I would like to take an extra mile to figure it out. So what I do is, I'll go to the most recent 10K report and I'll show you this footnotes. Might be you could have already seen it. If not, I will just show you. Okay, this is the footnotes I was looking for. So, in this footnote, Microsoft have clearly mentioned in the year 2025 they have generated $281 billion. From which segment they have generated $281 billion? They have provided clear breakdown. So they have multiple items like server products, cloud service, Microsoft 365 commercial gaming, LinkedIn, etc. So what now I'm going to do is figure out where each and every segment is located, tag it back to Ashwat's data, and get the weighted average of beta. Might be it will be confusing by a lot of talking, but I will show you what I mean. So here, revenue segment, domain, revenue, weighted average, weighted beta. So what I'm going to do now is to save some time of this video, I'm just going to copy paste the name of this into this revenue segment column and put what is the revenue for each revenue. And I will just fast forward this in the video so that you feel that video is not too long. So I'll just start putting the name. Okay, now what I did is I just copy pasted what are all the, not copy pasted, just typed in what are all the revenue segments and how much revenue Microsoft have generated each year from this. So now I will evaluate how much each and every revenue segment contributed to the total revenue. That is this number divided by this, and this will be an anchored one. Then just pull this down and put this as a percentage, and I will increase this. I'll also add one more column here and say beta. So now what I'm going to do is figure out which segment each and every line item here falls into Professor Ashwath's data, because Professor Ashwath did this extensive exercise and calculated what is the unlevered beta for each and every domain. So first, let's figure out what is the server products and cloud services fall into. So in my opinion, the server products and cloud services, because by end of a day, if it is cloud services, I think the more appropriate thing is going to the software and internet. So I'm going to just assume this will be in the software and internet business. Then the beta which Professor says is 1.60. What I'll also do is, because I did this exercise before, when the next one is cloud service, next one is cloud service, I'll just copy paste this there. 1.6, 1.6. Extend this one. Okay. Next one is gaming. So I think Professor gave one line item here specifically to gaming. Hotel slash gaming. Professor provided the beta as 0.95. So I will take that as a number. 0.95. 0.95. Next one, LinkedIn. By end of a day, LinkedIn is one of a software application. So I will come here and assume this is going to be the beta, and the beta for this is 1.22. Next one is Windows and device. This is by end of a day, Windows is nothing but the Windows operating system, and the device is nothing but the devices like I forgot, Mac Surface, sorry, Windows Surface, which Microsoft is selling. So I will go here. It is combination of two. I think one is in computer products or computer services, I think, or computer peripherals. But since both are in the same range, I'm going to use computer services. Next one is search and news advertising. For this, Professor gave already one line item as advertising, and the beta is 1.2. I'm going to use that 1.2. Then enterprise and partner services. I As of I understood from the business, it is referring to the software systems and application. So I'm just going to use the same. And again, this one is cloud service. So I'm going to use this an. Then finally, others, which even Microsoft hasn't provided what it is. So I'm just going to take the beta for this as one. So now I will calculate what is the weighted beta for each and every segment. So the weighted average is this number multiplied with this number. I'm going to project it all the way, and then now I will do a sum. So now I could see the sum of beta as per this evaluation is 1.46. I feel more comfortable in using this number in two ways. One, it is not just considering one business as Microsoft, it is considering other business operating the same domain. Second reason, I have categorized all the streams which the Microsoft company generates the revenue from and took a weighted average. So I feel in this way, I feel more confident to use this number rather than just taking some random way. So I'm just going to plug this number here, and I'm going to get a different number now, 1.46. And even the next one, as I mentioned, I have a concern is market risk premium. For this, first we need to understand which markets or which geographical location Microsoft operates in. For this, I already did this, so I will just show you the which footnotes you need to refer. This footnotes. Here, Microsoft have provided uh, no sales to an individual customer or a country other than US have accounted more than 10% of revenue for the fiscal year 2025, 2024, 2023. Revenue classified by major geographical area in which the consumer are located as only two, US and other countries. For this, professor also provided data on what should be the market risk premium for each and every country. I'll also show you that information. So professor have measured if the business is solely operating in US, you can expect around 4.61 percentages ERP. And if the country is happening, I mean, rest of the world, the professor is expecting the value to be 5.88%. So I'm going to consider the same number and do the same weighted average like what I did for the beta, which is revenue by region, USA, rest of world, and revenue weighted average, then MRP. So what Microsoft have mentioned is they generated $144 billion from US, 144546. Then from other countries, 137178. 137178. And the total is this plus this. Now the weighted average is nothing but this divided by this, and then this divided by this. So this two numbers I want it in percentage, so I'll make this change. And this one to be very consistent, I will put this, and I don't need any decimal. Now the MRP for US is 4.61, the global is 4.88. Sorry, 5.88. 4.61, 5.88. So now finally I will get weighted MRP, which is nothing but this number multiplied with this number, and then this number multiplied with this number. By summing up the two, I will get a value which is 5.23. So I feel more confident in using this number rather than what number I took. Even though it will be very minute difference. I think previously we assumed 5%, now we are using 5.23, and beta we assumed I think 1.07, now we are using 1.46. These are small changes, but I feel more confident in using this number rather than some holistic business number or taking some assumptions which I do. By this, we got the WACC, which is the weighted average cost of capital. Now let's use this number and go ahead and perform or evaluate the next steps and get the equity value per share. So to remind you back, we have calculated what is the unlevered free cash flow going to be for the next 5 years. But we wanted to know, as of today, what is the worth of these free cash flow. Might be yes, by 2030 they could generate $151 billion, but as of today that might not be the same value. So what we are going to do is apply the discount rate, that is nothing but the WACC which we have calculated, that is 11.7 percentage, to this, and get as of today what this numbers is valued. So we'll get started. Present value of free cash flow. So I'll put the valuation date. I'll just use the today function. Then I will put in the dates which we have. That's nothing but the end of or the projected end of Microsoft for the next set of physical years. So might be the way how we get the present value is our present value of free cash flow is equal to calculated free cash flow divided by 1 plus the WACC to the power of n. So here WACC we already know, and calculated free cash flow for each and every year is this one, and n is to what year we are powering. Like if it is first year, it should be power the 1, it should be second year, it should be power the 2. Might be one limitation in this step is we are going to consider the WACC as consistent throughout the 5 years. But technically, if you think will the WACC be similar, realistically not, because by end of the day the risk-free rate will change year over the year. The beta which you're assuming might be say the beta as of now we assume server products is 1.6, might be next year this beta can be say just 1.2 or even higher. So in that way the beta could change year over year. I mean, so not just beta, by changing the beta and even market risk premium, the end value of WACC will change. But we are going to assume pretty much WACC is going to be the constant for 5 years, which technically is not going to be the case, not going to be the case. But if you think, or if you get more insights about the business or the economical data, you can even plug in a different WACC as per your understanding as well. But for now, I'm just going to take a simple assumption that the WACC is going to be the same. So now I will first type in unlevered free cash flow, which is nothing but this numbers. Then for the n, I will put as, I'll add a column. This is first year, second year, third year, fourth year, and fifth year. Now I will do present value of unlevered free cash flow, which is nothing but this number. Might be what I will do is, even before doing it, I'll just put the WACC here. So I'll just link it directly. WACC is this number, and this is a percentage. This is nothing but I'm just linking here so that I don't want to switch between multiple tabs to get the number. So now this value divided by 1 plus the WACC to the power of this value. So now we got what is the, okay, I think I made a small mistake. This should be anchored because it should not move. Okay. So now we have figured out using this value what is the present value of unlevered free cash flow. If you could note, we said the business Microsoft is going to generate $151 billion, but at the rate of the discount rate, considering all the risk, as of today, it is only worth $86 billion. But if you technically think through, it is not exactly right what we did, because the to the power of 1 here we took by end of the first year. If you are doing this valuation on the day where the Microsoft has published the last year's physical report, this makes sense. But we are doing the valuation as of today, which means we are not going to have the time frame of the entire 1 year. We are just going to have the difference between as of today, that is as of today is December 24th, 2025, till June 30 of 2026. So we just need to calculate what is the difference between these two time frame and put the numbers across here. So rather than I doing multiple complex thing, I'll just use our Excel function itself to calculate me the days. It just saves me 51%. Yeah, technically this is almost right. I'm in now end of December, and from January to June it is going to be the 6 months. And I'm going to do the same. I'll anchor this and project it across. Might be you could argue in 2028 there will be 366 days, leap year, non-leap year. You could consider it, but I don't think it is going to make much difference. So I'm not considering that as a fact here. So now you could see previously it was like say around $89 billion, but after doing this step, it is like 80. I mean, instead of $89 billion, it just says $91 billion. So please make sure to do perform this step as well. And one more additional step I would do is, if you technically think through, again, we are already for 48% or nearly half the time as of now I'm doing the valuation. And technically, I'm not going to get this entire $71 billion as of now. I'm just going to get only what is the 52% of this value, because that's the stub which I'm going to use here. So I'll add one more step here, then multiply it with this number. So now I have got what is the present value of unlevered free cash flow for the next 5 years. So this is what we are expecting the company is going to generate as of this today, as of today's value. So with this, the step number 3 is done, which is calculating the present value of projected free cash flow. Now let's go to next one, which is getting the terminal value. So terminal value. For this, I will just do this. For terminal value, I mean, first, what is terminal value? We have projected what is going to be the free cash flow for the next 5 years here. But the understanding is the business is not going out of business or anywhere by end of 5th year. The business is even going to grow beyond the 5 years period. So we need to evaluate, I mean, we cannot forecast even beyond 5 years, because the business model will change and it's very hard to forecast the free cash flow. So we need to assume a number at which the company is expected to grow after the 5th year till the entirety. Typically, this number is going to be the GDP growth of the country where the business is operating. So what I will do is, I will put this as a terminal. I'll just put growth rate. I'll call it as G. So technically, the GDP of US government is on 3.253 to 3.25 percentage. So now what I would do is, I would first forecast what is going to be the 2031 free cash flow. That is, how I'll do is 2030 free cash flow into 1 plus G, which is this guy multiply with 1 plus this guy. So this is going to be the 2031 free cash flow. Now what we would do is, we will get the terminal value. For getting the terminal value, the formula is simple, which is nothing but divide this number with the WACC minus this 3.25. So now you will get a huge number. This. Okay. But this is the value as of 2030, because that's what we are getting it. So we need to figure out what is the terminal value as of today. Which is going to be nothing but the same WACC formula will apply, that is this one plus the WACC to the power of n. N is nothing but here going to be this above 4.5. So which is nothing but $1.1 trillion. Again, note all this dollars which you're talking is in millions. Might be if you could have watched the previous video, it would be clear. So with this, we have done this one, terminal value. Now we will get the total enterprise value. So that will be similar, total enterprise value. This is terminal value, sum of present value of free cash flow for 5 years. So this is nothing but this number, and this is nothing but sum of these guys. So now the total enterprise value is summation of this guy and this guy. We are seeing somewhere around $1.48 trillion. So now we got the total enterprise value, that is this one. Next one, net debt. The good thing is you don't need to do anything to figure out the net debt. We already calculated it while doing the WACC. So we'll put net debt. Net debt is equal to, if you go to this tab where we did the WACC, get in this number. Might be I'll tell you this as well again. Here you could see the 7832 here is nothing but the short-term debt or the current portion of long-term debt. The $35 billion is long-term debt, and the again $28 billion is the cash which they have. So that's why I'm calling this as net debt rather than debt or total debt. So now we are done with getting this value. Now we could go ahead and calculate what is the equity value. So the next one is equity value is total enterprise value and net debt summation. So here the equity value, total enterprise value is this, debt is this, and if you do the summation of these two numbers, you will get what is the equity value. And we'll just color code these guys so you don't feel lost in the numbers. Perfect. So now we are done with this one. Next one is getting the total outstanding share. So I will do this. Total outstanding shares. That is basic share. Might be basic shares. So what I do is I will go to the Microsoft SEC filings and get the most recent quarterly report. The most recent quarterly report is filed on October 29, 2025. I'll open this. If you go to the very first page, in the very last line, you could see what is the outstanding shares as of October 23, 2025. This is the most recent date, even properly from Microsoft is available. So I'll get this number. So it is saying 7432377. So please note, it is not anywhere in millions or in any denominations, but all the numbers we are doing in our calculation is in million. So here we need to divide it by 10 to the power 6 and get the number. So it is going to be 7432.377655. So we'll put in the number 7432.377655. So to be very clear, I'll put in all this. Okay, so this is the total basic share. But As I already talked about in the first part of video, we also need to figure out, is there any restricted stock unit? I already read through this. I'm not sure if it is here, but let me type it out. Mm, okay. For some reason, I don't see any footnotes on the most recent quarterly report on the restricted stock unit. But if I go back to the most recent annual report, which was published like 3 months before that, which is July 30, 2025, and if I do this, mm, okay. So here, what Microsoft have mentioned is they have some stock units which they have granted. I mean, this is again as per the annual report which was published in June 30. Here they have mentioned non-vested balance end of year there is 82 million shares, but we haven't got any information on the same in the most recent annual quarterly report. So now the confusion is, should we take it to, should we consider this number even though it was like in the most, not in the most recent filing? I would technically consider this because Microsoft as a business, they offer a lot of stock based compensation to the employees, and I don't see any strong reason that we should not include this number. So even though it is from the most recent annual report, I'm going to consider this as well as a stock, because by end of the day, even though it's non-vested balance as of June 30, 2025, might be right now we are in December 2025, these could have been already vested. But since we are not sure what is going to happen, to be on the safer side, I will consider this 82 as well as RSU. So RSUs is 82. So now this will give me the total outstanding shares, which is this plus this. Perfect. So I think pretty much we have done with all the informations. Now I'll do is I'll just type in this MSFT data stock Nasdaq. Yeah, this one I need. Current stock price, which is nothing but as of today, what is the price? As of the time I'm recording, Microsoft is trading at $488 per share. Our calculated stock price is nothing but the final step in our analogy, which is getting the equity value per share. We know what is the total value and we have the total outstanding share. Just divide those two numbers. This number divided by this number. So we are seeing it as 200 bucks, which I think is technically less than half of what is the current price. So upside or downside? No, I think I would leave it here. It's pretty much understood what is going to happen. So this is what we are seeing with the current assumptions we have took. But remind you, all the numbers which we did right now is considering the street case. But if I switch from the street case to best case, we are seeing the intrinsic value as $227 per share. Previously, I think it is 200 if I'm not wrong. Yeah, it was $200.18, but after switching to street case, it is $227. And again, lot of these numbers depends on the assumptions we took. Might be someone could come and argue, hey, you know what, the beta which you arrived is 1.46, which I feel is too high. They could say, you know what, maximum the beta can be on the 1.1 range. And again, someone could say market risk premium, you're expecting too much, 5.23 is too high, consider as 4.5 percentage. So if that is the case, I'm just changing market risk premium as 4.5 percentage and assume the beta I'm changing to 1.1. In that case, we are seeing the fair value or the current, the intrinsic value is $296 per share. So accordingly, these numbers will change. So I think let's wrap up this video here. So this is not going to be any financial advice either to buy or sell the stock. This is just for an informational or educational purpose only. If there is any questions or comments, please put in the comment section. If you found anything new or interesting in this video, please consider liking and subscribing to my channel. Thank you and take care.